Buffett's secret plan for 2026, how the rich are preparing right now. Warren Buffett isn't just a legendary investor, he's a living blueprint for wealth creation. As we move into 2026, whispers of market shifts, inflation pressures, and geopolitical uncertainty have left many investors anxious. But while most people panic, Buffett and the ultra-wealthy operate differently. They prepare strategically, position capital in high-value opportunities, and think in decades rather than weeks. In this video, we'll explore Buffett's secret plan for 2026, how the rich are preparing for potential market turbulence, and actionable steps you can take to align with their strategies. By the end, you'll understand not only what Buffett is doing, but also how you can adopt the mindset, strategy, and discipline of smart investors preparing for the future. Why Buffett's 2026 plan matters. As 2026 approaches, investors worldwide are asking the same question. What is Warren Buffett, one of the richest and most disciplined investors in history, planning next? Buffett isn't chasing trends, speculative fads, or viral stock tips. Instead, he is quietly observing long-term patterns, fundamental market shifts, and business behaviors that signal real opportunity. His moves are rarely sensational, but they are strategic, and history shows that following his principles can position ordinary investors to achieve extraordinary results. The rich prepare for uncertainty in ways that most investors overlook. While many react emotionally to headlines, Buffett looks at structural opportunities, sectors poised for growth, undervalued businesses, and assets that can withstand volatility. The 2026 landscape is rife with both risk and potential. From rising interest rates and geopolitical tensions to technological innovation and demographic shifts, the coming year will require more than luck. It will demand disciplined analysis, patience, and a Buffett-like mindset. In this video, we'll explore Buffett's secret plan for 2026, what sectors he is likely focused on, how the rich are positioning themselves, and the mindset principles that allow smart money to thrive while others panic. By the end, you'll understand not only where the opportunity lies, but also how to think like the world's wealthiest investors in uncertain times. The core principles behind Buffett's strategy. Buffett's investing philosophy has remained consistent over decades, and it centers on three core principles: value, durability, and patience. These principles are especially relevant in 2026, when markets may be volatile and headline-driven sentiment could mislead inexperienced investors. 1. Value investing. Buffett doesn't chase hot trends or social media hype. He looks for companies whose intrinsic value, based on earnings, growth potential, and fundamental assets, exceeds their current market price. For 2026, this means carefully analyzing balance sheets, revenue streams, and market positioning to identify businesses that are undervalued by the broader market. Value investing is not a shortcut. It's a disciplined approach that relies on rational analysis rather than speculation. 2. Durability. Durable companies withstand economic cycles, adapt to changing consumer behaviors, and maintain competitive advantages over decades. Buffett avoids businesses that may be profitable in the short term but lack long-term staying power. In 2026, durability could mean renewable energy firms with government contracts, healthcare providers with essential services, or tech companies providing indispensable infrastructure. 3. Patience. Perhaps the most overlooked principle is patience. Wealth accumulation is rarely linear, and markets often fluctuate wildly. Buffett's approach is to wait for opportunities, deploy capital selectively, and allow time and compounding to work in his favor. For 2026, patience will be key, as market volatility may create opportunities for disciplined investors while leaving trend chasers exposed. Understanding market conditions for 2026. Buffett's secret plan is informed by a deep understanding of macroeconomic, geopolitical, and technological trends. Unlike most investors who react to daily market news, Buffett evaluates long-term structural forces that will shape opportunities and risks. 1. Inflation and interest rates. Central banks are expected to adjust interest rates in response to economic conditions. Rising rates can reduce liquidity and increase borrowing costs, affecting cyclical sectors like real estate, construction, and discretionary consumer goods. Buffett's approach would focus on businesses that can maintain profitability even under tighter financial conditions. 2. Geopolitical risks. Global tensions, trade disputes, and political instability can affect market sentiment and supply chains. The rich prepare for these risks by investing in companies with diversified operations, strong domestic demand, or essential goods and services that remain in demand regardless of geopolitical disruptions. 3. Technological disruption. The acceleration of AI, cloud computing, and digital infrastructure creates long-term winners and losers. Buffett invests where technology solves real-world problems and generates predictable, recurring revenue, rather than chasing every emerging tech trend. In 2026, this mindset will allow investors to identify sustainable tech opportunities without succumbing to hype. Sectors Buffett and the rich are targeting. While Buffett rarely reveals his exact trades, his portfolio and historical moves provide strong clues about which sectors are attracting smart money for 2026. 1. Renewable energy. Energy demand continues to grow, but the shift toward renewables presents long-term investment opportunities. Solar, wind, and hydroelectric projects offer predictable cash flow, often backed by government incentives. Smart money is likely focusing on companies that combine innovation with stability, such as established utilities integrating renewable solutions. 2. Healthcare and biotech. Aging populations and increasing chronic illness rates create demand for healthcare products, services, and innovative therapies. Buffett's preference for predictable earnings and durable businesses aligns with healthcare investments. Companies producing essential medical devices, subscription-based services, or critical therapies are particularly attractive for patient capital. 3. Financial services. Banks, insurers, and payment processors remain foundational to the economy. Well-capitalized financial institutions are both resilient during downturns and positioned to grow during recovery periods. Smart money invests here to leverage market volatility while maintaining safety. 4. Consumer staples. Food, beverages, hygiene products, and other essentials are recession-resistant. Buffett's historical preference for strong brands ensures that even in downturns, these companies provide consistent cash flow. 5. Technology infrastructure. Buffett is selective with tech, focusing on companies providing essential services with recurring revenue, such as cloud infrastructure, cybersecurity, or payment processing. This approach balances growth potential with durability, reducing exposure to speculative bubbles. Historical insights, learning from Buffett's past moves. Buffett's 2026 plan is informed by decades of experience, navigating market booms and busts. 1. Dot-com bubble. Buffett avoided speculative tech stocks in the late 1990s, focusing on companies with real earnings. When the bubble burst, his portfolio remained resilient, highlighting the value of avoiding hype and investing in fundamentals. 2. 2008 financial crisis. During the global recession, Buffett invested in Goldman Sachs and Bank of America. While fear dominated the market, he saw undervalued financial institutions with durable assets. This demonstrates how crises can be opportunities rather than threats. 3. COVID-19 market crash. Berkshire Hathaway retained cash reserves while deploying selectively in companies whose fundamentals were strong. Buffett's ability to act decisively during short-term panic exemplifies the importance of liquidity and preparedness. The rich's psychological edge in 2026. Buffett's success is as much psychological as financial. The wealthy prepare not only financially but mentally for market turbulence. Emotional discipline. They remain calm while the market panics. Independent thinking. Decisions are based on data and fundamentals, not fear or media hype. Long-term orientation. Focus on decades, not months. Opportunity seeking. Downturns are viewed as buying windows, not catastrophic losses. Buffett's approach to risk management. Preparation is key in 2026. Buffett mitigates risk by 1. Avoiding leverage to maintain flexibility. 2. Evaluating corporate debt levels to ensure resilience. 3. Maintaining a margin of safety when acquiring undervalued companies. 4. Steering clear of speculative fads or highly leveraged ventures. 5. Reinvesting dividends and cash flows strategically to compound returns. Risk management is strategic, not fearful, and allows the rich to act confidently when others retreat. Identifying hidden opportunities in 2026. Buffett looks for companies that are undervalued, essential, and resilient. Key attributes include predictable earnings and cash flow, strong competitive advantages, moats, ethical and competent management, essential goods or services that withstand economic cycles. For investors, spotting these hidden gems requires discipline, research, and a willingness to act while the majority hesitates. Actionable steps to follow Buffett in 2026. Investors can emulate Buffett's secret plan with the following steps. 1. Audit your portfolio. Remove speculative assets. 2. Maintain liquidity. Cash is critical for seizing opportunities. 3. Focus on fundamentals. Ignore short-term hype. 4. Diversify strategically across defensive and growth sectors. 5. Think long-term. Invest with a decade-long horizon. 6. Evaluate management. Invest in ethical, competent leaders. 7. Stay calm during volatility. Use fear-driven dips as buying windows. Buffett's secret indicators for market timing. Buffett doesn't predict exact crashes, but monitors indicators such as price versus intrinsic value, corporate health metrics, debt, cash flow, earnings, macroeconomic environment, interest rates, inflation, trade trends, market sentiment extremes, greed versus fear. These indicators allow the rich to position themselves ahead of opportunities without chasing trends. Buffett-style investing. 1. Renewable energy. Solar companies with government-backed contracts may dip in the short term. Smart money invests based on long-term revenue predictability. 2. Healthcare providers. Biotech firms developing essential therapies provide durable earnings even during market turbulence. 3. Financial institutions. Strong banks or insurers can be acquired at discounts during downturns, providing long-term gains when markets recover. Transforming fear into opportunity. The rich view 2026's potential volatility not as a threat, but as a chance to acquire high-quality assets at discounted prices. Buffett teaches that fear is a signal for opportunity, not a reason to retreat. By maintaining discipline, patience, and research-focused investing, ordinary investors can emulate the mindset of the wealthy and turn market uncertainty into a strategic advantage. Buffett's mindset, the secret to long-term wealth. One of the greatest lessons from Warren Buffett isn't about stock picks or sectors. It's about mindset. The ultra-wealthy think differently, and their mental approach is as valuable as any investment strategy. For 2026, this mindset is central to understanding how Buffett and the rich prepare for uncertainty. 1. Patience as a strategic advantage. Buffett has repeatedly said that investing is not a sprint but a marathon. In an age where most investors seek instant gains, patience is rare and therefore extremely powerful. For 2026, Patience allows smart money to observe volatility, wait for the right opportunities, and deploy capital at the most favorable prices. While the public panics at every news headline, the rich see temporary dips as discounted opportunities to acquire durable assets. 2. Thinking in decades, not months. The rich don't evaluate success based on quarterly reports or monthly gains. They look at decades-long trends, from population growth to technological adoption to climate-driven energy transitions. Buffett's 2026 plan leverages this perspective, identifying sectors that are not only profitable now, but will remain essential in the next 20 years. This long-term focus allows investors to ride out volatility and benefit from compounding returns that short-term traders often miss. 3. Emotional discipline under pressure. Markets are emotional by nature. Fear and greed drive irrational behavior, creating opportunities for disciplined investors. Buffett's ability to remain calm during crises, like the 2008 crash or the COVID-19 sell-off, is what sets him apart. The rich prepare psychologically for turbulence, recognizing that panic leads to losses, while rational patience leads to wealth accumulation. 4. Independent thinking versus herd mentality. Buffett famously avoids trends and hype. He doesn't buy because a stock is popular or media analysts recommend it. The 2026 strategy continues this principle. Invest based on fundamentals and intrinsic value, not the crowd's excitement or fear. Independent thinking allows the rich to see value where others see risk, often acquiring assets at discounted prices during periods of mass panic. Sector deep dive, where Buffett and the rich are focusing. While general sector guidance is useful, understanding the specific industries and opportunities that Buffett and the ultra-wealthy are targeting in 2026 provides actionable insights for everyday investors. 1. Renewable energy and sustainability. Global energy consumption continues to rise, but the shift to renewable energy is accelerating. Solar, wind, and hydroelectric projects are receiving government incentives, private investments, and technological breakthroughs that reduce costs. Buffett's Berkshire Hathaway has a long history of energy investments, including utilities and renewable projects. For 2026, the smart money is likely preparing to capitalize on long-term infrastructure projects and energy transition initiatives. Investors can look at companies with predictable cash flows from renewable infrastructure, long-term government contracts or subsidies, strong balance sheets capable of sustaining capital-intensive projects. 2. Healthcare and biotechnology. Healthcare demand is driven by aging populations and rising chronic illnesses. Buffett understands that healthcare is essential, recession-resistant, and often undervalued during market dips. Biotechnology firms developing innovative therapies, medical device manufacturers, and healthcare service providers are likely high-value targets for smart money in 2026. Key considerations for investors. Companies with recurring revenue or subscription-based healthcare services. Firms with strong intellectual property, protecting competitive advantages. Businesses addressing fundamental, long-term healthcare needs. 3. Financial services and banking. Banks and insurance companies are central to Buffett's portfolio. As interest rates fluctuate and economies grow, these institutions remain highly profitable. In 2026, well-capitalized banks, insurance firms, and fintech innovators may offer attractive entry points for disciplined investors. Investors should examine debt levels and regulatory compliance, return on equity and earnings consistency, market position relative to competitors, 4. Consumer staples and essential products. Even in economic downturns, people buy food, beverages, hygiene products, and household essentials. This sector is a cornerstone of Buffett-style portfolios because of its predictable earnings, brand loyalty, and recession resistance. Potential opportunities for investors include companies with strong international distribution networks, brands with high customer trust and repeat purchase behavior, businesses that consistently pay dividends and generate free cash flow. 5. Technology with real value. Buffett is cautious about technology, but invests when the fundamentals are solid. Essential tech services such as cloud infrastructure, digital payments, cybersecurity, and enterprise software can provide predictable recurring revenue, making them attractive in 2026. Key indicators of strong tech companies. Subscription-based revenue models. Critical services that businesses or consumers cannot do without. Strong balance sheets and low debt. Lessons from past crashes applied to 2026. Buffett's historical investments provide a blueprint for navigating potential 2026 market turbulence. Dot-com bubble 2000. The tech frenzy of the late 1990s created companies with inflated valuations and no earnings. Buffett avoided speculative tech stocks, instead focusing on durable brands like Coca-Cola and American Express. The lesson for 2026: avoid hype-driven sectors and focus on intrinsic value. 2008 financial crisis. During the global recession, Buffett invested in Goldman Sachs and Bank of America when fear peaked and prices were depressed. He leveraged the market panic to acquire high-quality financial institutions at discounted valuations, reinforcing the principle that crashes are opportunities, not threats. COVID-19 market crash, 2020. Rapid sell-offs created temporary undervaluation. Buffett maintained liquidity, selectively investing in companies whose fundamentals remained strong. The takeaway for 2026: preparation and selective deployment of capital can outperform panic-driven investors. Buffett's secret indicators for market readiness. Buffett doesn't rely on predictions. He uses signals to assess market health and opportunity. 1. Price vs. intrinsic value. A stock's market price relative to its fundamental worth indicates whether it's undervalued or overvalued. Smart money enters when the gap is wide. 2. Corporate health metrics. Debt levels, cash flow stability, management quality, and market positioning are key factors to evaluate before committing capital. 3. Macroeconomic environment. Interest rates, inflation, fiscal policy, and global trade trends inform timing and sector allocation. 4. Market sentiment. Extreme greed or fear often signals opportunity. Buffett capitalizes on market psychology, buying when others panic and being cautious when markets overheat. Actionable steps for investors in 2026. Even ordinary investors can emulate Buffett's secret plan. 1. Audit your portfolio. Remove speculative or hype-driven investments. Focus on businesses with durable competitive advantages and predictable cash flow. 2. Maintain cash reserves. Liquidity allows you to act when high-quality assets are undervalued. 3. Focus on fundamental research. Evaluate earnings, debt, and market positioning before investing. Ignore headlines and short-term volatility. 4. Diversify with purpose. Invest across defensive and growth sectors, but avoid over-diversification that dilutes returns. 5. Think long-term. Wealth accumulates over decades, not months. Compounding and patience are essential. 6. Evaluate management quality. Invest in companies led by competent, ethical, and disciplined leaders. 7. Prepare for volatility. Expect short-term downturns. Use dips as buying opportunities instead of panic selling. 8. Apply a margin of safety. Buy below intrinsic value to minimize risk and maximize upside potential. Psychological lessons: how the rich think differently. Buffett's 2026 strategy is as much about psychology as it is about numbers. Rational decision-making, Avoid emotional reactions. Evaluate opportunities based on facts. Independent thinking. Don't follow the herd blindly. Analyze fundamentals. Patience. Wait for the right opportunities instead of chasing every trend. Resilience. Accept market volatility as natural and prepare strategically. Opportunity-oriented. Crashes and dips are not threats. They're gateways to wealth if approached wisely. Step-by-step, sector-by-sector investment guide. Buffett doesn't pick stocks randomly. He evaluates sectors based on durability, cash flow stability, and intrinsic value. Here's a sector-by-sector breakdown for 2026. 1. Consumer staples. Step 1. Identify strong brands. Look for companies with global recognition, brand loyalty, and consistent earnings. Examples include beverage giants, packaged food companies, and personal care producers. Step 2. Analyze financial health. Check debt-to-equity ratios, profit margins, and cash flow stability. Step 3. Evaluate defensive positioning. Ensure products remain in demand even during recessions. Step 4. Timing. Enter positions during temporary market dips to maximize value. 2. Healthcare and biotech. Step 1. Focus on essential services. Target companies producing life-saving medications, medical devices, or services with recurring demand. Step 2. Assess innovation pipelines. Evaluate R&D efficiency, patent protection, and clinical trial success rates. Step 3. Durability check. Prioritize firms that can sustain revenue growth over decades, not just years. Step 4. Risk management. Avoid firms with high dependency on a single drug or unstable regulatory approvals. 3. Financial institutions. Step 1. Examine capital adequacy. Buffett prefers banks and insurers with strong capital buffers. Step 2. Profit consistency. Focus on institutions generating steady interest income or insurance premiums. Step 3. Look for market opportunities. During volatility, smart money buys stakes at discounts when fear drives stock prices down. Step 4. Timing and entry. Deploy capital gradually during market corrections, maintaining liquidity to seize additional opportunities. 4. Renewable energy and utilities. Step 1. Identify stable revenue streams. Utilities with long-term government contracts or regulated pricing provide predictable cash flow. Step 2. Assess growth potential. Focus on companies expanding into solar, wind, or hydro infrastructure. Step 3. Risk mitigation. Evaluate political and regulatory risks, energy price fluctuations, and technological disruptions. Step 4. Patient strategy. Invest incrementally, holding through market volatility to allow compounding over years. To prepare for 2026, it's crucial to understand how his approach performed through multiple decades of market turbulence. 1970s, stagflation era. Inflation and energy crises created uncertainty. Buffett invested in businesses with pricing power and durable demand, like consumer staples and insurance. Lesson: in inflationary times, companies with strong margins and essential goods outperform speculative stocks. Comment below with your thoughts on Buffett's 2026 strategy. Share with friends who want to invest wisely. Subscribe for more actionable insights from the world's smartest investors. This video is for educational purposes only and is not financial advice. Always consult a licensed financial advisor before making investment decisions. Investing carries risk, and past performance does not guarantee future results.